Both Mr. Organ and Mr. Epstein in the second panel raised the concerns that short positions exceed the physical supply. The second panel kind of argued that that wasn't a concern. Are you concerned that the shorts will not be able to deliver if called upon?
No. I am not at all concerned. For one thing, it has been persistently that way for decades. Another thing is that there are any number of mechanisms allowing for cash settlements and problems, and a third thing is as many people who are actually knowledgeable about the silver market and the gold market have testified today that almost all of those short positions are in fact hedges. The short futures positions are hedges, offsetting long positions in the OTC market. So I don't really see a concern there.
Do you think I'm stupid? You fool. I don't believe that for 1 second.
Why, you better. You sheep. I'm the almighty gatekeeper. You don't know shit.
Note. It is interesting that Mr. Christian is not concerned about the ability of the shorts to deliver because they can cash settle. He clearly has no understanding that when someone wants to buy precious metals, giving them cash instead is a failure to deliver. It is a default. But he is not concerned. He says that the short position is actually hedged by a long position on the OTC, but we will see later in this testimony how he describes the OTC physical market, and we will see that the long position is not bullion but is in fact an unbacked or only partially backed IOU bullion.
I know what it is. Just ask the goddamn question. Yeah.
Okay. Shit. Back to the subject. I appreciate the difficulty of trying to do this by remote, but at the end of your testimony you start talking about bona fide hedge exemptions for commercial traders and must be part of position limits, and not to grant hedge exemptions to swap dealers would be devastating for liquidity of exchanges and the price discovery capacity, and we got into who determines what is legitimate, but could you amplify on that a bit and what you see as a danger there?
Yes, I can amplify on it. But amplify on it a bit is more difficult because it is a very big subject. The first thing is that precious metals, copper, other metals, energy, these are all traded internationally and are fungible commodities by and large. There are lots of strange things that have been misspoken about the difference between the wholesale and the retail market, and we don't really have the time to go over those, I think. If you start putting position limits on bona fide hedgers, for example, the bullion banks, and the previous fellow was talking about hedges of paper on paper, and that is exactly right. Precious metals are financial assets like currencies, T-bills and T-bonds. They trade in the multiples of 100 times the underlying physical, and so people buying them are voting and giving an economic view of the world or a view of the economic world. And so when you start saying to a bank, I have a number of people.
People where? In your ass?
Well, actually, let's go back to a concrete example of Mr. Organ when he was talking about August of 2008, when there was an explosion in the short positions in gold and silver held by the bullion banks on the futures market, and he seemed to imply that that was somehow driving the price down. If you understand how those bullion banks run their books, the reason they had an explosion in their short positions was because they were selling bullion hand over fist in the forward market, in the physical market, and in the OTC options market. Everyone was buying gold everywhere in the world, so the bullion banks who stand as market makers were selling or making commitments to sell them material, and so they had to hedge themselves, and they were using the futures market to do that. So if you place position limits on the futures market, they will have to find some other mechanism to hedge themselves, and they will. And someone else will provide that market.
You are hopeless. You make me sick. You said that the bullion banks had large shorts to hedge themselves selling elsewhere, and I didn't understand. I might just not have followed it, and you closer to the metals markets than me on this. But how do you short something to cover a sale? I didn't quite follow that.
Well, actually, I misspoke. Basically, what you were seeing in August of 2008 was the liquidation of leveraged precious metals positions from a number of places, and the bullion banks were coming back to buy it, and they were hedging those positions by going short on the COMEX, and that is really what it was.
You invent the most ridiculous poppycock to explain away the blatant manipulation of the precious metals in 2008. If, in your own words, investors were buying gold hand over fist everywhere in the world, why would leveraged long holders dump all their long holdings? They would have ordinarily been making a fortune. The Bank Participation Report of August 2008 shows that 2 or 3 billion banks sold short the equivalent of 25 of world annual silver production in 4 weeks and the equivalent of 10 of world annual gold production. There was simultaneously a decrease in their long positions, which were almost non-existent anyway, which is incoherent with the notion the bullion banks were mopping up dumped leveraged investments. So what are bullion banks? I am just trying to understand what are bullion banks hedging on the other side. We heard from other panels, but you seem to be familiar. Is it warehouse receipts? What is it?
Well, it's a tremendous number of things. If you look at a bullion bank's book, its gold book for example, you will see an enormous number of things. There will be gold forward purchases from mining companies, there will be forward purchases from refineries, there will be gold that has been leased out to electronics manufacturers, component manufacturers, and countless manufacturers and jewelers. As gold flows through the beneficiation process, and again these are all long complex issues that are hard to reduce. But you know, a lot of producers will sell their gold the moment it leaves their possession at the mine. It might be in concentrate form or it might be in ore form. It then goes to a smelter or a refinery. The bullion bank buys it and it agrees a price at the time it is buying it, but it won't be allowed to sell that metal until the refinery outturn, which may be 2 weeks, but it could be 6 months. So they will go into the market and short the market in order to cover the commitment they have.
So, there is not much real metal. Is that right?
You're not as stupid as I thought you would be. I've just screwed up. I should have kept my mouth shut. Oh well. It's almost done anyway. I admit it. We don't have much metal. There are 100 paper slips per 1 ounce of metal. We can't even give real metal to most people who have claims. Except for China and Russia. They seem to know what vault the metal is in and take it. They have us by the balls, son. However, you Americans and Westerners are straight up jacked. Ha! Ha! Ha!
I'm British.
I don't care. You have been jacked, son. Instead of buying all that junk, you should have bought some gold and silver. Your central banks and the Federal Reserve helped us to clean your pockets. Now you all are broke and null and void. Your money is worthless.
You fool. We still have a chance. We can still buy metals. And the more we buy, the more closer you are of running out, and poof, you're out of business. This is not over yet, Jeffery Christian. You and your buddies are going down.
We'll see if you broke-ass sexual chocolates can pull off such a thing. Ha 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 ha. Lima beans.